Hey guys, so welcome back to the channel. Today I have an amazing trading strategy which I'm going to backtest for you over 100 trades. I will first tell you about the indicators we're going to be using, show you a few examples, and then perform the 100 trade backtest. You'll see this strategy is the best that we've ever tested so far. So it involves 3 trading indicators: the average true range, the MACD, and the parabolic SAR. So the average true range, also known as ATR, is a technical analysis indicator that measures market volatility by decomposing the entire range of an asset price for that period. The true range indicator is taken as the greatest of the following: the current high less the current low, the absolute value of the current high less the previous close, and the absolute value of the current low less the previous close. The ATR is then a moving average, generally using 14 days of the true ranges. The second indicator is the moving average convergence divergence, also called MACD, and it's a trend following momentum indicator that shows the relationship between 2 moving averages of a security's price. The MACD is calculated by subtracting the 26-period exponential moving average from the 12-period EMA. But for this strategy, we're going to be using a longer period EMA. And the final indicator is the parabolic SAR, which attempts to give traders an edge by highlighting the direction an asset is moving, as well as providing entry and exit points. So this backtest is based on the 1-hour time frame on USD JPY with a rolling stop loss. So here's the strategy. We go long when the MACD is negative and a bullish parabolic SAR cross is formed. And similarly, we go short when the MACD is positive and a bearish parabolic SAR cross is formed. The second rule is that we place the stop loss at 2 ATR. We don't have a maximum number of trades that we can have at any given time. And the final rule is that when the open profit reaches 1R, we move the stop loss by 1R in the direction of the trade. So let's get on the charts now so I can show you a few examples and then we'll dive into the backtest. All right, so here we are on the charts. We've got USD JPY on the 1-hour time frame. We'll go ahead and add the 3 indicators that we're going to be using. So we've got the MACD, parabolic SAR, and the average true range. We'll go ahead and change the settings for the SAR. So change it to slightly thicker. And this is 0.04, 0.04, and this is 0.02 by default. For the MACD, we're going to be using a much longer period. So that will be 200, 3, and 3. We can change the style slightly so that we can see the lines a bit better. And finally, the ATR, we can leave it to the default settings, which is 14. Essentially, what we want to do is use the MACD as the trend indicator. So when the MACD, when it's negative, we're looking for long positions. And when it's positive, we're looking for short positions. So in this case, you can see it's negative. So essentially, we go long when we've got a bullish SAR cross. So in this case, for instance, it would be here. After this green candle, we would go long, and the stop loss would be 2 ATR. So that means that for this candle, we've got a value of 0.2. So we're looking for a stop loss of 0.4, basically at a price of 122.2. Stop loss would be around this. So I'll show you a few examples and then we'll dive straight into the backtest. So here you've got a negative MACD. The parabolic SAR cross is formed, and so we go long. The ATR has a value of 0.1, so we've got a 0.2, a 20 pip stop loss, and we ride it until the price comes back to 1R. Essentially, it reached a maximum of 1 to 4, 1 to 5 risk reward ratio. So essentially, we would have moved the stop loss to 1R, or to break even, 1R, 2R, 3Rs, and then 4Rs, and then it would have hit the 4R stop loss. So you would have made a 1 to 4 risk to reward ratio trade, and then this would be a loss. This would have been a break even trade, this as well. And then the MACD would become positive, so we're looking for short positions. You would have entered here for a short position with a tight stop loss, so that would have been a loss. However, here you would have entered a short position again with an ATR of 0.12, so that gives a 24 pip stop loss. and then you would have ridden the whole way down to a maximum of 1:8 risk to reward ratio. So essentially you would have been stopped out at 1:7 right here. So let's go ahead and do the back test, and I'll see you for the results. All right, guys, the results on USD JPY. We had a maximum drawdown of 14%. We were risking 5% per trade with a variable risk to reward ratio. We had 31 wins, 14 losses, and 55 trades that ended up in break even. We had a maximum of 4 wins in a row and a maximum of 3 losses in a row, with a win rate of 69% over 49 days. That's pretty insane results. We've got 529% of profit. So if you would have started in December 2021 with $10,000, you would have ended up with $52,000 in January 2022. To be honest, this is really surprising. When I was performing the backtest, a lot of the trades were break-even trades. As you can see, is 55% of the trades, but in times of trending markets on the 1 hour time frame, you know, as you can see from the charts, the results compound massively. So let me know what you guys think in the comments, and I'll see you in the next video.